If you've ever opened a trading chart without knowing how the price was moving, where to enter a trade, or why the market kept reversing, causing you errors, then this video will help you view charts more clearly and easily. We're going to demystify these complex charts by mastering one of the most powerful yet easily misunderstood tools in trading, trend lines. I'm really excited to guide you through this because once you learn how to see market structure this way with a few incredibly simple rules, you'll never forget it. So, let's get started. Why do so many traders lose money using trend lines? That's a major source of frustration for beginners. You see, most new traders just draw lines everywhere. They try to force them in, hoping one of them will magically work. Ultimately, this only turns their chart into a highly subjective mess. But today, we're going to tackle this thoroughly. We're establishing a simple, solid, foundational method that experts use to overcome the chaos and find high-probability setups. Below is our clear 5-step roadmap for the trading journey. 1. The foundation of trend lines. 2. Drawing accurate trend lines. 3. Reading trend momentum. 4. Identifying timing on lower time frames. And 5. Waiting for a breakout. Starting with part 1, the foundation of trend lines, eliminate the noise. Now, unlike horizontal support levels, which are usually quite obvious to everyone, diagonal trend lines can be subjective. To completely eliminate guesswork, we have an absolute golden rule for beginners. A trend line must have at least 3 touch points to be considered valid. A touch point is simply where the price drops, touches an invisible diagonal line on your chart, and bounces back. If you only have 1 or 2 touch points, frankly, that's just a coincidence. But a third touch point proves the market actually respects that particular line. If you don't have 3 clear touch points, you simply don't have a trend line. It's really that simple. Next up is part 2. Drawing accurate trend lines, the master techniques. When it comes time to draw the line, the first step is to find the 3 touch points we just talked about. The second step is cutting the candle wicks, and the third is avoiding the candle bodies. For beginners, candle wicks are thin shadows on the chart that show a temporary price surge. In fact, your trend line can absolutely cut through these wicks. But thick candle bodies, which characterize the core consensus of the market, should be avoided. If you have to cut through a solid candle body just to make your line fit, you need to delete that line immediately. It's invalid. Don't use it. This leads us to part 3, reading trend momentum, the market tug-of-war. Once you've drawn a perfectly valid line, it's not just a diagonal line on the screen but also acts as a real-time measure of momentum. It's like observing a visual tug-of-war between buyers and sellers. On one hand, a steep trendline angle means rapid increases and extremely strong momentum. Buyers are actively participating, but on the other hand, a flat angle indicates a serious weakening of strength. If a trend starts quite steeply, but you find yourself having to draw new, much flatter trend lines, that indicates buyers are running out of strength, and a full-blown trend reversal may be imminent. Trends never just move in a straight line forever, do they? There's always up and down. If the downtrend is descending extremely rapidly, sellers are in complete control at that point. If the upward corrective wave is rising very slowly and really struggling to make any progress, then buyers are extremely weak. Recognizing the specific speed difference tells you that the likelihood of a continued decline is very high. Let's move on to part 4, timing on lower time frames, from micro to macro zoom. Okay, so we've identified the big picture, but how do we actually enter a trade without taking on too much risk? This is where the magic happens. We use what's called micro to macro zooming to optimize entry points. Consider this your insider. First, identify the upcoming 3rd or 4th touch point on your larger macro chart, for example, the daily chart. Then, zoom down to the 1, 5, minute, or even 5-minute chart. Finally, wait for the trade to bounce off the trend line at that micro level. You're actively using the main macro trend line to find highly accurate, low-risk entry points on smaller time frames. This is really great, but I need to warn you about a major trap you must avoid here. Be wary of unsustainable price surges. If the market is trending well and suddenly spikes off the established trendline almost vertically, it'll move. Do not jump in. I repeat, do not chase it. This move is very fast. Don't jump in. I repeat, don't chase it. These are usually just late arriving panic buyers rushing in out of fear of missing out, FOMO, while early buyers are already ready to take profits. When that happens, the price almost always bounces back sharply to the trend line, and you don't want to get caught in that situation. And finally, part 5, wait for the breakout. Patience will pay off. We've talked a lot about price bouncing off trend lines, but what happens when the market pauses and consolidates? You'll see this pause takes the form of a flag pattern or a wedge pattern. This is a high probability consolidation phase where pressure is building up within an established trend. I want you to imagine a spring coiled tighter and tighter. The trend lines move closer and closer together until the pressure builds up strongly, leading to a powerful breakout. Now, this is a very strict rule from our sources, and it speaks directly to those impatient traders out there. Wait for the market to truly and completely break out of a pattern. Trading inside a pattern while it's just oscillating is a dangerous and extremely common mistake. You might feel like you're missing out by standing on the sidelines, but real experts always let the market reveal itself. They wait for a clear, undeniable trendline breakout before investing any capital. This is exactly how you should do it. Step 1. Wait for pressure to build. Step 2. Observe the initial breakout. And step 3. Observe the breakout and retest. That third step, that's where the magic happens. Often, a broken trend line reverses its role. An old support line is broken, the price comes back to retest from the other side, and suddenly it acts as a new resistance level. This is why you should never immediately erase a broken trend line from your chart. And one final piece of advice, always keep an eye out for springs. A spring is essentially a failed or false breakout. The market attempts to break down below a pattern, fails immediately, is strongly rejected, and reverses back down. This false move creates immense pressure in the opposite direction. Honestly, a failed pushdown is one of the strongest signals you can get for an explosive bull run. The sellers have tried to regain control. They failed completely, and the buyers swooped in with overwhelming force. So, to conclude this explanation, I want to leave you with one final thought-provoking question. Are your trend lines built on solid touch points, or just wishful thinking? Apply everything you've learned today. The strict 3 touch point rule. Cutting wicks but never the body, reading momentum angles, and using the excellent micro to macro zoom tool to identify entry points and apply them to your chart now. Stop guessing and start trading based on actual structure. Thank you so much for learning with me today, and see you in the next explanation.